Welcome to the Audit FUN podcast. My goal with this podcast is to bring relevant internal audit topics to the table at least every 15 days. Today, I have as my guest Alex Sidorenko. Alex is the Risk Manager of the Year in 2021 in Europe, had an honorable mention by RIMS in the US in 2021, and is the founder and host of the Risk Awareness Week. Welcome, Alex, to the podcast. It's an honor to have you on.
Thanks, John. Thank you. And hello to all the listeners.
Yeah, absolutely. So today we're going to be talking about risk management. You have a lot of thought-provoking ideas and concepts in this field, so really looking forward to our conversation here. First question, we'll start with the basics for the internal auditors out there. If you were an internal auditor, how would you go about auditing risk management?
And I was. Although I graduated as a risk manager from the university, and I was kind of a risk manager forever, I did work as an internal auditor for a while in consulting. And so let me try and answer that in a structured way. So first point, let me try and kind of in key messages, key points. Point number one, never ever audit risk management if you don't have a good risk manager on your team. I mean, my God, how many auditors have I had to sit down and listen to, and the amount of rubbish I heard and the amount of nonsense I heard from internal auditors that made me for a second believe that internal auditors are the worst human beings on the planet. Just for a second. So yeah, just like you wouldn't audit a complex infrastructure project without an engineer on your team, don't audit risk management without a very competent risk management person on the team. Because risk management is not building a risk register or a framework or a colorful heat map. Risks are not likely versus major red on a map. Risk management is hardcore mathematics. And unless you have a degree in mathematics, stay away from auditing risk management. Don't kid yourself. You're not qualified to even walk near risk management as the process unless you have a competent risk manager on the team. So risk management is one of those highly specialized business processes that requires probably some sort of outsourcing specialist, or at least some independent risk manager to brought into the risk team. And I'm not kidding. Like in my career, I had my risk management audited by internal auditors twice, by external auditors every single year, and I've never had so many dumb conversations in my life. The amount of stupid feedback, comments, and just ridiculous non-scientific recommendations, I've never seen so much in my life. So that's a very long introduction. So how do you actually audit it? Basically, risk management is four things. Risk management is, so to audit risk management properly, it's actually four things. Thing number one, there's this concept which I call risk management one. It's basically doing risk management for regulatory purposes. For some bizarre reason, regulators in many countries have legislated certain requirements for risk management. All of these legislative requirements are ridiculous at best, completely wrong and unscientific and astrology-like at worst. So regulators are not doing a good job at trying to capture the essence of risk management. It's much worse outside of financial services, but even in financial services, the regulators are doing a pretty decent job with credit risk. They are pretty embarrassing with market risk. They are horrible, like beyond embarrassment, with operational risk. And environmental risk, forget about it. The regulators, they're just a joke. Tax risk, tax-related risk, the amount of legislation written and some of the legislation like literally prescribes formulas how you supposedly quantify risk, and those formulas are making the kind of the basic year 7 mathematical mistakes that you would avoid if you did any kind of quantitative education in your life ever. So it's embarrassing beyond belief. And so nevertheless, the regulators continue to push down a certain path. And for simplicity's sake, I just call it risk management 1, which basically means do whatever the regulators ask. Yes, it's bad math. Yes, it's astrology. Yes, it has nothing to do with proper decision making and risk management, but it's just easier to do what the regulators ask and forget about it. So we call it risk management 1. And to audit risk management in general, you have to first audit risk management 1. And there it's very simple, does it exist? If the regulator says you should have a risk appetite statement, you bloody better have a risk appetite statement. Yes, it's useless. Yes, it has nothing to do with decision making. Yes, it's a waste of time. But if the regulator insists on having one, you better have one. So you have to go through all the regulatory requirements, and every industry, every country has their own specific, unique regulatory requirements. You just go like, do you have it? Yes, 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 yes. But then the biggest question in risk management 1 is, are you not wasting too much time on this window dressing? Because it literally is window dressing. And the most important question the internal auditor should ask, are you not getting too much excited about this window dressing? Are you not wasting too much management resources and the budget on doing this basically rubbish? Because you have to do it, but you have to do it quickly. And so hopefully a good internal auditor would look at risk management 1 and say, well, if it's just a facade, if it literally is just window dressing, why on earth did you spend few months of management time and getting together like workshops and doing risk registers and reviewing and updating? Like, why are you spending so much of company time and salaries on doing this? Because this is not risk management. This is just window dressing. You have to do it as quickly as possible and just forget it's ever happened. And so first question out of 4, there are 4 questions in auditing risk management, and this is going to be a slightly longer answer to your first question. I mean,
that's okay.
It's not the lightest of the questions to start a podcast with.
Yes.
But number 1, risk management 1, does it exist? Is it quick? Like, is it super quick? Is it quick and painless? Because if it's not quick and painless, and most of the organizations fail in making it quick and painless, they make it actually slow and painful for the management. They literally conduct various workshops. They come up with some ridiculous methodologies. Like they have arguments. Should a heat map be 3x3 or 5x5? Well, both of those heat maps are astrology. They're nothing like but a horoscope. They have no connection to proper scientific risk management. So in the question of should a heat map be 3x3 or 5x5, there's a very simple answer: whatever is easiest, because it's all rubbish. And so whichever one is easier, of course 3x3 is by far easier than 5x5. It's a simple question. So of course you would settle for the easiest window dressing possible, because the only purpose is window dressing. So that's number 1 out of 4. Number 2 is where it becomes difficult, is risk management 2. And risk management 2 is basically, how is risk analysis, quantitative scientific risk analysis, based on actual decision science, probability theory, integrated into decision making? When the company signs off on the budget, do they run scenarios? Do they run simulations to see how different assumptions affect the budgeting parameters? When they make an investment decision, how is the fair value of investment is calculated? Are the risks incorporated into the calculation of fair value? Because apparently, nobody knew, but apparently doing a sensitivity analysis plus minus 10% on your key parameters in your valuation is not good enough. That's not real risk management, and you have to do it. You have to do it properly. So risk management 2, that's the second point out of my 4. That's the big one. That's like the 90% of the audit. You look at actual decisions taken by the board or the management, and you figure out, well, have risks been considered? Have they been properly taken into account? Have mitigations been taken into account? Is the final decision risk adjusted? Are we still making the decision ignoring the uncertainty, or have we adjusted our decision to account for uncertainty? And so that's the second kind of the second point, and that's a big one. Then the third one is what I call risk culture, because basically integrating into decision making requires people to believe and live the story, and believe into what they're doing. Because once the risk manager is in the room, it's actually quite easy to talk about risk, because when the risk manager is in the room, everybody talks about risk as well as the risk manager. But as soon as the risk manager leaves, then the room usually completely forgets about the risk, because they're motivated by other things and their bonuses are paid from performance that is not risk adjusted. And so the risk culture is a huge part of risk management effectiveness, and therefore has to be audited as a separate activity. Does the risk manager train, provide competencies, educate, monitors the competencies? What do the people say? Do the decision makers believe in risk? Do they believe in the methodology? Do they, walk the talk? Do they actually talk and think about risks when they're making decisions, regardless of whether the risk manager is in the room? So the third one, the big one, is risk culture. If you were to audit risk management, you have to specifically look at what happens to decisions when the risk manager is not present in the room, and what happens to all the other decisions where the risk manager hasn't had a chance to integrate himself into. And that's number 3. And number 4 is when I would audit risk management, and I've audited risk management in many companies all over the world, is look at the actual risk management team. So number 4 is look at the risk management team itself. Are they competent? Do they have competencies in probability theory, decision science, behavioral economics, the actual industry where the company is working, and some of the kind of advanced quant competencies that are required to process large chunks of operational data, loss data, or incidents, and so on. So the fourth point that I would look at when I would audit risk management is, well, what does the risk management team look like? Do they have sufficient resources? For example, I was working for a very large multi-billion-dollar, $10 billion fertilizer company, one of the biggest in the world. And the shareholder came from a financial background. He used to be a banker. He was a big fan of risk management. And he constantly was saying, we need risk models for different type of risks. We need all decisions to be risk adjusted, and so on. And he said, I want things to be done in a way that is similar to a bank. And I want the accuracy of your risk models to be very high. I want to have a lot of confidence into the risk analysis that you do. The only trouble is that at the time when he said that, the risk team had 4 people, which is not bad for an average non-financial company. But the trouble is, when you go to the level of sophistication of a financial services, well, they usually have 80 to 200 risk managers. And so if you want super advanced risk management, you can't do it with 4 people, sorry. You have to have the resources appropriate to the level of sophistication. And so anyway, the team expanded to, I think, like 60 people within a year or so. But that's an indication. If there is a demand for sophisticated risk-based decision-making in the organization, well, the resources have to be appropriate. The number of people, the level of competency of people, the software that they use, the access to data that they require, all of that should be in place. And that's all part of the kind of the fourth point to audit. Because the shareholders or the audit committee can say, we want the best risk management in place. Well, you can't have that with like 2 or 3 people in the risk team. So forget about it. You have to settle for something reasonable unless you give more resources. And I think that's where the internal auditors can be quite helpful in saying, well, if you want the best risk management, then you have to support it with resources.
With resources.
But if you're not prepared to support it with resources, then you have to settle for normal risk management, reasonable risk management. But then don't go around annoying risk managers saying, "Oh, we wanted. Why didn't you think of that? Or why didn't you incorporate this into your risk analysis?" Well, because we've built our framework, our models, our methodology for your level of sophistication. Everything is kind of fitting the resources available. So if I was to audit risk management, I would look at risk management 1, is it quick enough? Risk management 2, how sophisticated, integrated it is. Risk culture, do people think and talk about risk when risk manager is not in the room? And who is the risk manager or the risk management team? Are they sophisticated enough, competent enough, qualified enough, and sufficient to meet the shareholder requirements?
Yeah, very, very good points, all 4 points. And I do want to focus on the second point more, because I think that's kind of like what you're really big on for sure, being more quantitative and bringing that into the decision-making process. So, and this is not necessarily a question, but more of like, when I try to get your reaction here, there's a phrase out there that says, there are lies, damn lies, and statistics. So, which kind of implies, sometimes quantitative methods may be wrong, right? So to your point, for risk management 2, which is the quantitative side, is there any method that it's a bad method for quantitative processes?
So this is a very loaded question, because there's a lot to unpack. Because that phrase, that way of putting the question forward, it implies the world, and this is kind of, I will try and slowly bring you into the world of risk management. It implies the question, and it's not a bad question because it's a very common question, but the question implies that the world is deterministic, and this is the first, welcome internal audit listeners. This is the new word that you'll learn today.
There you go.
Deterministic implies that the world is linear and there is right or wrong answer, and there is kind of one way of looking at things, and then that's the kind of the internal audit view of the world. But in reality, it's the trader's view of the world. It's everyone's view of the world. Finance, accounting, they all live in a deterministic world, where, for example, you say, in the budget, we will forecast sales to be 100. Well, in reality, you would, I hope, know that in reality sales can fluctuate, and in fact they will fluctuate every month. And in fact, in a year, it could be 100, it could be 105, it could be 120, it could be 200, it could be 90, 80. There's uncertainty.
Right.
And in the risk management world, we view the world as stochastic. Stochastic means it's affected by random variables. And one of my favorite sayings in English is the future is plural. It means that there's, in the view of the risk manager, there's no single future. There are multiple possible futures, and you actually have no idea which one is going to happen, because that's the nature of uncertainty. We're dealing with uncertainty. We have no idea what the future will actually hold. We can only estimate what the future will hold, and we can estimate a range of possible outcomes. And so, in risk management world, the future is stochastic, which means to estimate and to make any kind of forecasts, you always have to talk in ranges. You have to say from A to B, from A to Z, and your range is the wider the range, the more uncertainty you have. In fact, if you know nothing, the range is humongous. If you know a lot, the range is smaller, but it's still a range, because you're never certain about the future, because you cannot, unless you're certain about something. If you are certain about something, then there's no risk. If there is presence of risk, that means there is a presence of uncertainty. So there's always a range, and shrinking that range to something that is acceptable to the decision maker is the objective of risk management. Because when you look in the future, the range is just humongous, and you constantly try to shrink it. So in that sense, when we talk about lies, damn lies, and statistics, it implies that there is some sort of future fact, and we can misjudge that fact using statistics. Well, that is fundamentally incorrect interpretation of what we're trying to do, because we never know what the future is, and we're not even attempting to guess what the future is, because risk managers are not fortune tellers. We don't know what the future is, but we're trying to reduce the uncertainty around the future, and that reduction in uncertainty actually helps us improve the quality of decision making. It helps us improve in the quality. So yes, technically speaking, I can take a historical data, internal or external, and I can come up with all sorts of crazy things to make forecasts about the future. But I wouldn't do that, because my job is not to create a future that can be either right or wrong. My job is to create with a range of possible future outcomes, and hope that the actual future that will happen will fall within the confidence interval that I've selected. Now, here's another interesting thing. Risk managers operate with this concept called confidence interval. That means I can say what the weather will be tomorrow or next year with a 60% confidence interval, which means that the range will be huge, or an 80% confidence interval, or a 90% confidence interval, or sorry, I showed you the wrong. With the 60% confidence interval, with the 80% confidence interval, with the 90% confidence interval, with the 99% confidence interval. So the more accurate the business wants the risk manager to be, the broader the range will be, because we realize that if you want us to be accurate 90% of the time, then the range will be significantly bigger. If you want us to be 99% of the time accurate, then the range will be humongous, because there's just so much uncertainty, so much risk. And if you want us to be 100% accurate, then we will walk away, because no risk manager will ever state anything where he's 100% confident into something, because there's always uncertainty. And so whether there's lies, damn lies, and statistics, that kind of more reflects the application of statistics in forecasting, where you're trying to create a single point estimate. And the reality is you're wrong with your single point estimates almost always, because the future is uncertain. But what we're trying to do is we're trying to create ranges that give you that appreciation of uncertainty. If you're saying, oh, I want to be 99% confidence, well, then the weather next year could be between 0 and 40 or 50 degrees, and I'll be right 99% of the time. And I'm talking Celsius, obviously, because that's what the rest of the world is using. And so yes, I could be very creative with the methodologies I use, and I can take a lot of shortcuts in the mathematics I use. But the very idea of risk management is not actually give you a precise answer. The very idea is to highlight how imprecise your forecasts are. For example, management is saying, we will sell 100 units next year. And you're saying, well, based on the risk analysis that we've done, you can actually sell somewhere between 60 and 180. And that's a lot of uncertainty. That's probably more uncertainty that you want in your business plan. So you better mitigate the risks, because with this much uncertainty, you're not really doing a good job at managing that business. And the final point on this statement that I wanted to say, which is well, actually, the final 2 points. There's a kind of never-ending this quest for saying, qualitative, shall we have a quick conversation and decide whether the risks, high, low, medium, or shall we spend significantly more time? And, make no mistake about it, quantitative risk analysis is time consuming and quite complex.
Right.
And in fact, remind me a bit later, I'll talk about, I have this new idea that risk managers are divided into users and generators. And only some of them can actually do quantitative risk analysis. Others are not meant and are not capable of doing quantitative risk analysis in their life. So risk management is significantly more effort. And there's this general debate about, well, shall we do like a quick fix, or shall we spend the time and do the quantitative? And it's all measurable, because a lot of scientists have actually conducted the research to say, well, is our intuition in qualifying risks and ranking risks better or worse than mathematical models? And Philip Tetlock is one of those scientists. He came up with a very simple conclusion. He said, I found no discipline on earth where intuition or qualitative opinions, judgments, assessments of risk would be better than simple mathematical models, yet alone more complicated. So for the scientists that have spent the time and done the research, there's no evidence to suggest that statistical methods or mathematical methods have more error than your qualitative, intuitive, subjective opinions. These qualitative opinions, even though they're quicker and less painful in terms of the methodology and the effort, they have been proven to show more error. That means that they misguide your decisions more than if you did no risk management at all, and you're actually significantly better off by quantifying. So I know a lot of people will listen to this who have never come across the research by Philip Tetlock, Doug Hubbard, God, what's his name? Tony Cox, and a few other scientists in both US and Europe who have spent the time to investigate this very important question. And since I suspect that many of the listeners would have no knowledge of these individuals and the research that they've done, I welcome you to write, to find me, and it's very easy to find me on LinkedIn or my YouTube channel, to find me and challenge me and give me a single piece of evidence to suggest that you think qualitative risk analysis improves decision making as opposed to it actually ruins decision making. So the second point that I've just made is that yes, you can lie with statistics, but you're definitely lying with qualitative assessments. So that's the point I was trying to make. Yes, as the professional risk manager, I can lie with it. Like, I can tweak the data in so many ways you wouldn't even realize that. I can lie with statistics so easily, it's scary. What you have to realize is that if you don't use statistical methods, then you are guaranteed to be lying to your senior managers, to your audit committees, and to your executives, and to your shareholders. So, whether you're guaranteed to be lying or you can be lying, that's a big difference to me. And the third very quick point that I wanted to make on this, I forgot. So I'll come back to it when I remember.
We'll come back to it, and we'll put the challenge out there to the internal auditors who are listening. If there's a qualitative method that you think it's better than a quantitative method, you can contact Alex on LinkedIn. So I think your point about the goal of risk management is to shrink the range. That's a very good takeaway for the listeners here. So there's another phrase out there, and I think this is from Donald Rumsfeld. In the early 2000s, he said there are known knowns, which is stuff that we know. There are known unknowns, which is stuff that we know may happen, but we don't know what's the probability that it may happen. And there are unknowns, which is stuff that we don't even know that may happen, right? So in risk management, in your opinion, what is the way to move those unknowns to something that's more quantifiable, if there is a way to do that?
Yeah. So thanks, John. That's a very good question. Let me kind of dissect that phrase, because this is a very like soap opera phrase, because we in quantitative world, we don't think in terms of known, unknown. We think of different, like we think about risk in a very different perspective. And let me try and describe that. Every risk on the planet, and this is a very important message. I am now going to say a few things which internal audit listeners will probably have, like, it will just go over their head. Like, they will not even register what it means, which is exactly the point I'm trying to prove. If you're going to audit risk management, better bring somebody who understands what I'm talking about, because this is like the basic level of risk management, and everybody needs to understand that. But if you what I'm going to say next, if you don't understand that, that just means you're forbidden from auditing risk management. It's very simple.
All right.
So every risk on the planet is a distribution. A distribution is basically like a loss exceedance curve. Loss exceedance curve has three important components. It has expected losses, which is your basically P0 to P50. This is how much you expect to lose from a given risk in a given time period. And usually that amount is used for adjusting budgets, because if you know you're going to lose this much money, and this is a very important philosophical message. Business is not risk-free. Whatever the business is doing, there will always be risk. So you will always have expected losses, which means if you sell into clients and you give them credit and you expect them to pay later after the goods have been delivered, some clients will steal from you. That's a given.
Yes.
That's a given. Over your portfolio of clients, somebody will steal. It's not that you have to go upset and surprised by it. It's actually stupid for people to be surprised about things that are expected to happen. And so any risk on the planet has expected losses, which means that your budgets have to be adjusted for these expected losses, because it's stupid to budget knowing that you will lose a certain amount of money throughout the year due to a given risk, and you ignore it. And then you just kind of, we didn't meet our budget. Well, of course you didn't meet your budget, because you didn't include the expected losses. That's the name, expected losses. That's what you expect on average to lose. You can actually lose in real life. You lose less or more, but on average, this is how much you expect to lose from a given risk. So every risk is a distribution. It has three components. Component number one is expected losses. You have to budget for those, because they will happen. The longer you observe, they will happen on average. The second component is unexpected losses. Unexpected losses is basically your plausible worst case scenario. So what you're saying in this risk, whether the risk is fire or clients stealing your goods or explosions in the chemical plants, like anything, whatever the risk is, the unexpected losses, this is your plausible worst case scenario, which means, depending on your confidence interval, 95% of the time you wouldn't lose more than X, and X being your VAR, value at risk. That VAR is very important, because at some stage the risk manager needs to consolidate all the VARs from different risks together and say, well, if these worst case scenarios happened and they're correlated, so if they happened in some sort of plausible scenario together, will the company survive? So that's like the second output of risk analysis. The first output is, how much do we need to add or deduct from our budget? For example, if we forecast that our sales will be 100 million and our expected losses from the sales are, 5 million, then we should budget for 95. because it's silly to budget for 100, ignoring the 5 that we're going to lose based on the risk analysis that we've done. And that's expected losses. So unexpected, then you have to combine all those VARs together and say, well, will the company actually survive? Do we need more capital? Do we need to reach out to the shareholders? Do we need to have some sort of loan structure to protect the company liquidity should all these risks happen simultaneously? And that's your unexpected losses, and yet that's your kind of the big portion of your risk. And then after your confidence interval, after your VAR 95 or VAR 97 or VAR 80, whatever the confidence interval is in your company, and by the way, figuring out what is your confidence interval for a company is actually a humongous task and a very important conversation to have with the shareholder, because some shareholders will say, oh, we're fine with P90, and others say, no, we want P99. And then you say, as the risk manager, you say, well, if you want P99, that means we need to build much more sophisticated risk models, which means we need like 40 extra people. Are you sure you want P99? And it goes like, well, not really, because it actually costs like an extra $1 million in salaries. So that's your second chunk, which is your unexpected losses. And then the final chunk of the distribution is the tail. And that's where you have unknown unknowns. Sometimes you have I don't know what's the known unknowns. You know what the type of things could happen, but you don't know how likely they are. For example, I used to work for a chemical company, so we knew that ammonia could explode. But we never had any incidents like that. The world had very few incidents where something like that exploded. So we didn't know how likely that was. But that's the tail. And also in the tail, it's basically two things in the tail. The known unknowns, you know that a certain part of the equipment could explode under certain conditions, but there are also unknown unknowns. For example, I don't know, a meteorite could fall on which literally happened in one of the plants in the middle of Russia somewhere. Could fall on the plant and just destroy it. So that all sits in the tail, and with the tail, this is just such a fundamental thing. Risk management does not have the competencies or the methodologies most of the time to estimate the tail. You literally you say, okay, we understand what the expected losses are, we understand what the unexpected losses are, and we plan for a plausible worst case scenario. But there are more worst case scenarios that are so remotely unlikely that we have no idea how likely they really are. We think there's a less than 5% probability of them happening, but we don't know what exact probability that they will have, and we shouldn't, because for the tails, you don't really mitigate the tails. You insure or hedge or just reserve for the tail. Part of the business is realizing that there are certain events that could just completely destroy, like a war. For example, war happening in Europe right now. I mean, they just destroyed so many businesses that no risk model in the region ever predicted. But that wasn't even the job of risk management. So the very important point that I want to try and make, in risk management, we're very realistic about what we can quantify and what we shouldn't quantify, because the math in that region is just so ridiculous that it's a lie at best. So
you don't have data.
Well, you don't have enough. You never have sufficient data, because it's one in 1,000, 1 in the 10,000 type events. Even if it's 1 in 100 years event, like you would have maybe a couple of points somewhere around the world, it is not enough to properly quantify it. So there's no again. This is actually not proven science. Like that, I haven't seen a paper that says there's no point quantifying tail. That's actually that is literally just my opinion. I have given it a lot of thought. I have spent a lot of time working on it. I have even attempted to quantify the tails from different directions, and I personally came up with the conclusion that there's no point quantifying the known unknowns and unknown unknowns, as long as you know that they exist and you have some sort of plan B like your recoveries, your business continuities, your insurances, your hedging strategies. As long as you have something, or the shareholders are aware of the risks and they accept the risk, and they say, well, if something happens, then the whole plant explodes, and we'll deal with it later. We'll build a new one, and we'll just write off the whole cost and everything else associated with that. Then that's the end of the road for risk management. So risk management is not really, in my opinion, again, risk management is not about the tails. Risk management is about the body of the distribution, which is your expected and unexpected losses.
Yeah, that makes sense. I think that's fair to say because, if you expected a risk manager to predict that tail risk, you would be driving yourself crazy, and it would be extremely cost prohibitive to, stakeholders, shareholders, and so forth. So, last question here, and that's changing gears a little bit. Something that you talk about that I noticed on LinkedIn: reputational risk. There is no such a thing as reputational risk. Can you elaborate on what you mean?
So I've written an article. Reputational risk is not a risk. And it was a very popular article with tens of thousands of reads. I do not, and I'm being very honest, I do not remember the main message of that article, because since then I've written an article called ESG is the worst thing to happen to risk management since GRC. And that kind of overshadowed all the conclusions in my mind. So I actually, I don't think I'll make it up right now. I can't remember what the main message was in reputational risk is not a risk. It is a very solid message because I've been thinking about it for a long time, and I've been backtesting it a lot. I think it has something to do with Nicholas Taleb's notion of X versus f of X, which basically means it is stupid to quantify or stupid to think about a risk unless you have a specific tool set to mitigate that specific risk. So, for example, we wouldn't be thinking about credit risk or market risk if we didn't have a set of commercial market tools, techniques to hedge and deal with those risks. So it only makes sense to think about a given risk if there are mitigation techniques that are specifically designed for that risk. And for reputational risk, there's no such thing, because reputation is such a broad umbrella that it just implies, a million of other random things that are just piled under this umbrella, and each of them have different mitigations. So there's no mitigation, there's no market mitigation for reputational risk, which means it's kind of silly to try and quantify and measure this reputational risk because it's not a thing. It's only a thing if the market made it a thing and created products and created an industry around that thing. Because, for example, market risk is not really also a thing, or foreign exchange risk, or credit risk. But because the market created a thing around it, then we just accepted it. And that was one of the points. And the second point, f of x, it actually makes much more sense to quantify and measure the effect different reputational events have on cash flows. So anyway, it's a very simple article to find. It's called Reputational Risk is Not a Risk, or Reputational Risk is Not a Thing, or Reputation is Not a Risk. I think if you Google either one of those names, it's going to be number one in Google, because it's easy. It's quite easy to find. It's a very popular article. So I do encourage the listeners, if you think reputational risk is a thing, and I assure you it is not, go ahead and Google and find out why, because I bring a lot of quite scientific arguments on why it's not a thing. And the same for ESG. The article I called ESG is the worst thing to happen to risk management since GRC. Kind of trying to take a stab at the two things I hate most in my life. And I hope the listeners kind of realize that I'm not this crazy uncle that just goes around says, "Oh, ESG is bad, ESG is bad." I have put a lot of thought into that. In fact, I also modeled a lot of environmental risks scientifically And I saved company millions of dollars by doing proper risk analysis, and that's one of the reasons why I did get Risk Manager of the Year in Europe last year, and a special honorable mention in US by RIMS, because last year we saved like $13 million to the company by doing proper risk analysis. So whenever I make a claim, there's usually a lot of science and backtesting and proven evidence behind it. So you just have to, as in you readers, just have to take a little bit of effort to read the arguments, because the arguments are quite solid. It's not just because I don't understand ESG. I understand it so well to realize that it's just a rubbish concept. And literally the worst thing to happen to environment and climate change because it should have been and could have been so much more beneficial for the planet than what it turns out to be now.
Yeah, you have the goods to show. So it's not just your opinion. You have actually done extensive research on the topic. So really appreciate you being on the podcast, Alex. For those who maybe want to challenge you on the things that you brought up during this conversation, or just want to connect with you to learn about what you do, what's the best way for them to reach out to you?
So the best place is this annual event that I'm doing since 2019. I started doing an online conference. I called it Risk Awareness Week. And it is literally a week. It's 5 days of like 50 different workshops from the risk professionals that I trust. So like Stanford professors, NASA engineers, some of the best risk managers, they're not risk managers. They are the people that teach risk managers to risk management to risk managers. Some of the best people I respect and love on the planet. Some of the best senior risk managers, engineers, like real scientists who do proper like the guys that do risk analysis in the basement of Pentagon when it matters. Not when you have to produce a corporate risk profile and present to the audit committee, but when you do risk analysis when lives are at stake, and when nuclear submarines are at stake. Like that's the kind of risk analysis that I believe in. And so every October we get together for this Risk Awareness Week, and if you Google Risk Awareness Week, you'll find the next October's 2022 Risk Awareness Week, which is going to be exciting. And you can find me there because I'll be doing a number of workshops, and as well as all the friends that I bring together. They will be doing a lot of workshops describing what we actually implemented and what results and what we've backtested, the actual practical models, the risk analysis, what we've done to show how it can improve the quality of decision making. So that's the best place to find me. But then, of course, you can just Google Risk Academy. Risk Academy is one of the biggest blogs on the planet. It has both the YouTube channel and the blog. It usually comes up in like number one in the Google search. And if you want like a condensed version of my thinking, I and a friend of mine actually wrote a book many years ago, which is still number one free risk management book on the planet. So if you literally just Google free risk management book, it's gonna be number one. And that kind of a very concise summary of all the different ideas and thoughts that I have on the topic. So it's like it's a nice short introduction into the risk management to the world where risk is not a corporate risk register or a heat map, but something useful for the decision makers.
Yeah, a lot of resources, a lot of ways to connect with you. So Risk Awareness Week in October here coming up, and you got your website, Risk Academy, and also the free book online for those who are interested, free risk management book. So really appreciate you being on the podcast. Thank you so much.
Thanks, John.